This is the BiggerPockets Podcast, show 586.
Do not fall for the temptation of actual cash value insurance policies. In most cases, a lender will not let you do that. But if you're buying a property for cash or you're doing some kind of non-traditional debt structure, don't fall for the trap of, cool, I can save a little bit on my premiums, because the minute you have a loss, that will come back to bite you big time.
What's going on, everyone? It is David Greene, your host of the BiggerPockets Podcast, the show where we show you just how powerful real estate investing can be. Our guests include food servers and firefighters, counselors, and corporate execs. People with a wide range of backgrounds with one thing in common. They got the real estate bug, they got educated, and they took action. Now, it's our job to help you do the same. Now, we are going to do that today by bringing in my personal friend and multifamily investing partner, Andrew Cushman. Andrew Cushman has been on this podcast several times. I believe this is his fourth appearance, and he is a multifamily investing specialist. On episode 571, we dug into what he calls phase one of his underwriting, where he looks at, would this property possibly work if everything went great? In today's episode, we get into phase two, where we verify, is everything actually great, and could this deal work? Now, this is a very, very detailed, practical, sort of information-packed episode where you could take the information and literally create the same system that Andrew runs. And I hope that many of you do. If you've ever learned what goes into analyzing multifamily property, this might be the most important episode or piece of information that you watch ever. This will teach you more about investing in multifamily property than you probably ever heard in your life. And that doesn't mean that you need to actually go do everything we talked about, but this will give you amazing insight into what goes on that will give you confidence in your own investing and maybe help you understand if multifamily is a niche that could work for you. There's all kinds of different strengths and weaknesses associated with each asset class of real estate. And today we dig in pretty deep on what goes into multifamily investing. Now, there's 8 steps that I'm going to want you to follow. And at the end, Andrew and I talk about a deal that we're going to be putting together that you can get more information on. So make sure you listen all the way to the end to learn about that. And if this is your first time hearing about Andrew or multifamily investing, please go back and listen to episode 571 after you finish this so you can see what led up to it. Now, if you end up liking this episode and you're like, man, I like learning about something new that I didn't see coming, today's quick tip is going to be to go to biggerpockets.com/store and check out the books that they have. There's books on all kinds of topics, and it's good to read them just to get a feel for if you would like investing in that type of asset class. And if that's really where you want to put your focus and attention in learning to grow. The other thing you can do is get on the BiggerPockets forums and ask questions and see how many other people are thinking the exact same things as you and trying to figure out the same questions that you're trying to figure out. So many of us think that we're on this journey on our own, and we're really not. Everyone else is taking it with us. So get hooked up with some people on this hike and this journey to the top of the mountain that we're all taking. It will be very encouraging for you. Without further ado, let's get into it with Andrew Cushman. Andrew Cushman, welcome back to the BiggerPockets Podcast.
Hey, good to see you again.
Thank you very much.
I think it's going to be a great day. I put the left earbud in my left ear on the first try. That's always a good sign.
Is that your barometer to tell how things are going to go?
Yes, it's very predictive. Yeah.
I like it. People are getting a behind-the-scenes look on just how to be successful in real estate investing.
That's the key right there. Yeah.
Now, today's show is going to be a master class on underwriting multifamily property. So heads up, if you're not into multifamily, this is one that is definitely going to be focused on that niche specifically. But I think that there's value that you'll get out of this anyways, because we're going to go into really the fundamentals of real estate investing. The specifics of how to evaluate multifamily are going to be covered, but there's always a why behind what we're doing. Now, we had Andrew on episode 571. Where we went over what Andrew refers to as phase one of his underwriting when it comes to multifamily properties. Can you give us a brief summary of what those 6 things were?
Yeah. So the phase one underwriting was just, and we won't go through all of the different steps, but the phase one underwriting was just the quick and dirty. Like you've got 10 properties in your inbox. You did the screening that we talked about way back in episode 271, I think it was, or 279. And 279. And you said, okay, well, these 3 look interesting, but you don't want to spend 8 hours underwriting them. So you just go through and make some fairly positive assumptions about rent growth, expenses, your debt, all of that, and look at it and say, well, okay, I spent 30 minutes, 15 minutes underwriting this. Under the best case scenario, these rosy assumptions, the deal doesn't work, trash it, right? But if under those rosy assumptions, it does look like a great deal, that's when you move to phase 2, right? Because you've done the screening, you've done phase 1, the cream rises to the top, but turds float there too. And phase 2 is where you're going to figure out that if the property in question, which one of those it is.
The turd test.
The turd test, yeah.
Brandon's not here, so that's probably the best that I can do coming up with names.
All right, well, we'll take it.
Okay, so we also talked about the 4 levers that really, really make a deal work. Can you go over those briefly?
Yes, and there are other levers, but as we discussed, these are 4 of probably some of the 4 of the most powerful ones. One are your rent growth assumptions. So did you assume 2% rent growth or 3%? And over a 5-year time frame, that's cumulative and it has a huge effect. Mm-hmm. The second one was, what are your cap rate assumptions? Did you assume cap rates stay flat? Did you assume they go up 100 basis points or 50 basis points over your hold time? That changes things significantly, especially if you're looking at IRR. The third one is the time of sale. Are you planning on underwriting for a 3-year sale, a 5-year, 10-year? What if you're going to hold it indefinitely? Moving that endpoint significantly affects how you underwrite, and are you looking at IRR or cash on cash? So that's another huge lever. Mm-hmm. And then the final lever we talked about was leverage itself. Are you going in with 65% LTV debt, loan to value, or are you trying to max it out at 80? Are you with like a bridge loan? Are you trying to put preferred equity on top of that to get to 90? So those are the 4 levers that we went in a lot more in depth, and that can very significantly affect your underwriting.
And you really want to understand those levers, because if you're going to invest as a limited partner in somebody's syndication, they might have fudged the numbers by putting these levers in places that aren't natural. So, for example, we mentioned cap rate assumptions. If you're not super into multifamily, all that means is a cap rate is a measure of how desirable an asset is in any specific market. The lower the cap rate is, the more people want it, and the lower a return an investor will accept to get into that market. If a general partner or the syndicator is assuming that demand is going to go up, meaning cap rates are going to go lower, they can make the deal look a lot better on paper than it's actually going to be. When Andrew does deals and when we do deals, we assume the opposite. We assume cap rates are going to go higher, which means that there will be less demand. And it's a more conservative approach. If the deal still works under those conditions, it's much less likely to fail. So that was some really good stuff at just understanding how easy it is for somebody to sort of manipulate numbers when they're making an offering, as well as you can talk yourself into a deal being a good deal by kind of playing with those levers.
Yeah, you're 100% right. It applies both ways. If you're looking to invest as an LP, you want to understand the impact that those things have so that you can dive into their underwriting and make sure that either they are not intentionally pulling a lever they shouldn't, or just unknowingly pulling it, or maybe you just don't agree with their assumptions. And then, if you're doing your own, you can make a spreadsheet tell you anything you want, and so you've got to be cognizant that you're not doing that. Well, if I just assume the cap rate doesn't move, this is a great deal. Real world is often different than spreadsheets, so be careful.
We've all been there. That's exactly right. So phase 1, like you mentioned, is just, hey, if we assume the best, does the deal work? Because if it doesn't work under best circumstances, don't look at it at all. Mm-hmm. And it doesn't really take that much time. And another thing I really love about the system Andrew has here is this can be leveraged to other people. So Andrew, you have 2 people on your team that for the majority of these deals, they're actually working phase 1 underwriting, and they're only coming to you or putting more time into it if it passes phase 1 underwriting. So anytime you can create something like what you've done here, it makes it easier on yourself to leverage anything you want to add on what things have been like since you made that change.
Yeah, so like you mentioned, we've got so it used to be me looking at everything and doing every step, and it was brutal, and I started to get burned out on it, where a deal would come to my inbox and I'd be like, oh geez, another deal I got to underwrite. I lost the excitement, right? Whereas now, we have a virtual assistant that's worked with us for a couple of years now who does that screening process that we talked about way back on 279. Then I have an acquisitions person who does that phase 1 underwriting that we talked about in our last episode. If a property looks like it's cream and not a turd, then he sends that to me. We talk a little bit. He then goes into phase 2, and then we proceed from there. So when you go to phase 2, is it screened well, it passed phase 1 underwriting, and it looks like a property that you want to own and or you think is at least worth putting an offer on. And that's a whole nother topic to get into on another time, but there's a lot of different reasons you'd want to put an LOI on a property, even if you might not necessarily want to win the deal on the first bet. This is the process, phase 2, that helps you decide under what price and terms that you would consider doing that. And so, this is definitely more time intensive, so you don't want to do it on every deal, only deals that have high potential and or properties that you think you'd really want to own.
All right, everybody. So buckle your seatbelts because you're about to get some high-level practical information that you can actually take away from the podcast and apply the minute that you leave into evaluating a deal. There's going to be 8 steps to underwriting phase 2. Anything you want to add before we get into those?
Yeah, I say if you're used to listening to podcasts on 2x speed, don't do that because I'm already going to be talking fast.
That's a great point. All right, so what is step number 1?
Step number 1, rent increases. And so there's a number of components to this. There's market rent growth over time. There's hopefully you found a value add deal. So there's a component of bringing the property up to where rent should be today. And then we're going to talk about actually step 2 is loss to lease. And they both factor into rent increases. But we'll save loss to lease for just a minute. So as far as regular rent increases, first we're going to talk about, we talked actually in phase 1 about market rent growth over time. That's where you're assuming, okay, market's going to keep going up 2.5% or 3% a year. But how you determine where market rent should be today is we use what's called a scatter chart in Excel. And I'm going to pull up a visual here. So if anyone is just listening and you're not on YouTube, I'll try to explain this so it's understandable, but the best thing to do is go to YouTube and take a look at the chart that we're showing. So what you're seeing now is a 1-bedroom rent comp analysis. And by the way, these are real. We didn't make this up. These are from deals that we actually have offered on. We did take out the name of the actual property, so we don't have 100,000 people going to look at it. But this is real data. And in this example here, we're looking at 1-bedroom rent comparables. And you'll see on here there's Oceanside, East Park, Laurel Creek, Westview, Whispering Pines. These are all comparable properties to the one that we're looking at. And on the chart, there's a bar that's labeled in red called 1 by 1 unrenovated. That is an unrenovated unit at the property that we are doing our phase 2 underwriting on. And how the chart works is the bottom axis is the square footage, right? So as you move from left to right, that means a smaller unit to bigger unit. The vertical axis is rent. So on the low end, this chart starts at 800 and it goes up to 1200. And so what we do is you take all of these, when you get a bunch of data from Axio or CoStar or wherever, and all these different floor plans and different sizes and rents, it's kind of hard to just look at all that and figure out, well, okay, where's my rent, right? So you make it visual. And so what we do is we take all those data points, we put it into Excel, and we create this scatter chart. And then if you look, there's a blue dotted line that kind of goes from bottom left to upper right. It's called a regression line. Basically, there's a nasty statistical definition of what that means, but basically it's just a visual line that shows how the different data relate to each other. And what you'll see is the reason the line goes from left to right is because rent tends to increase in that market as the unit size goes up.
As the property gets bigger.
As the units get bigger. People generally are willing to pay more money for larger units. And the steepness of this line kind of tells you how much that submarket values a bigger unit. But the most important thing that we're trying to show here is if you look at our 1 by 1 unrenovated unit, it is sitting at $900 a month in rent. Every other property is $1,000 or higher, right? So by plotting these, you can immediately look at this and go, well, okay, I should be able to do a light renovation and at least get the rent from $900 to $1,000. All right. And if you look at the chart, you'll see that we actually have the 1 by 1 renovated, it's the one that's in green, at $1,025. say, well, okay, Andrew, why is it, which is slightly above two of the other data points? Well, all right, Andrew, why is that one higher, right? If the regression line's right at 1,000, why do you have it as 1,025? Because part of our analysis is we looked at those other comparables and saw what the interiors were like and said, okay, well, if we spend $6,000 or whatever the number was, we can meet or exceed those, plus our our professional management with a lot of experience in that market, we have high confidence that we can get to 1,025. So that is what we found to be the most effective way to quickly and accurately at the same time determine how much rent bump you can get. Right. Again, there's more that if you're buying a property, you're going to go visit these property tour, and actually tour these comps and all that. But when you're sitting at your desk doing phase 2 underwriting, saying, okay, I assumed in my phase 1 that I can raise rents $100 a month or 150. Is that true? This is where you're verifying if that rosy assumption was true. And based on this chart, these units should pretty easily get to about 125.
Now, I see you have several different complexes, it looks like, all the different names of them. How did you go about gathering the data that you put into this chart for what Whispering Pines gets, Westview, Laurel Creek, et cetera?
Good point. So we try to get it from as many data sources as possible. So we'll get it from Axiometrics, CoStar. We'll ask, and anyone who's tried to sign up for CoStar is like, Andrew, that costs an arm and a leg. You're right. So we don't pay for it. We go to brokers and property management companies that do and say, could you please send us a report for this submarket or for this property?
Nice.
Yeah. And then we also, ALN is another source of data. But also what we do is we perform our own surveys. We will get online and look up every property just using Google, apartments.com, rent.com, and get every property in the area, call them, get it off the internet, get all our own data, and then ideally we have 2 or 3 sources for the same data set. We compare them and try to get them to line up as much as possible and then plot them on this chart.
Wonderful. Okay, so tell me how you would, let's say that you had a rosy assumption and then you pulled up this chart. What would let you know, hey, stop right there. We're not going to be able to get the rent bump that we're going to need. Yeah,
right on. So if it's one of those things where, we had a call with the broker and they're like, oh yeah, you can easily get these things to $1,200 a month. The seller renovated one unit and he leased it for $1,200 a month and you should be able to do the same. So, okay, cool. In phase 1, boom, $1,200 a month. Oh, this property looks great. We do this. Sorry, no, it's only going to be 125, maybe 150 best case scenario. So we go back, change the underwriting, and it might kill the deal. So then that's what you look just like in phase 1, you're looking for reasons to say no.
There you go. This is the verify part of Trust But Verify.
Exactly. Yes.
Okay. Anything else you want to cover before we move on to the next step?
Yeah. You know what? Just to get it all in, let's go ahead and keep on moving. So the next part of this that I want to talk about is number 2 is loss to the lease. And to be fully transparent, I was in the business for several years before I even fully understood what that actually meant. All right. So here's what loss to lease is. Let's say you've got a 10-unit apartment complex and you are advertising that your rent is $1,000 a month. But when people walk in the door, for whatever reason, maybe you're asking too much, maybe you didn't hire the right leasing person, whatever. When people walk in the door, you're actually leasing it for $950, right? You're marketing it for $1,000, but when that lease is signed, it's $950. So how that's treated is you are losing $50 a month to that lease, right? So market's $1,000, but your lease is $950, so your loss to lease is $50 a month, right? So
okay, let me see if I can make sure that we understand here. What you're saying is if you're being told that the unit will rent for $1,000 a month, you're putting it into your rent estimator at $1,000 a month.
Right.
But recognizing that's not accurate, you looked and see, well, what is it actually renting for? Only $950. So you have to subtract that $50 from somewhere, and you create the category called loss to lease to do it. It sounds very similar to how vacancy is used. When I was new at investing, I just took I would say, well, it's going to rent for $1,000 a month, but I have a 10% vacancy rate, so I'll just put $900 a month in for rent. That's actually not the right way to do it. You should put in the full 1,000 and create a separate category for vacancy where you take off 100. Is that the same principle working here?
Yes, it is. And what happens is loss to lease sounds like a negative thing, and it is if you're an owner. But if you're a buyer, it's an opportunity that you're looking for. And candidly, loss to lease is my favorite value add because it has the lowest execution risk. All right, so we talked about the situation where your market, you got 10 units, you're marketing them for 1,000, but you're actually signing leases for 950.
Can I interrupt you again real fast? What's a reason why somebody would put a tenant in at 950 when they're marketing it at 1,000?
We saw this a lot during COVID. People were just nervous and like, dude, if I can get someone that's actually going to show up and pay, I'll give them a discount.
Okay.
Yeah.
So maybe for whatever reason, they had a special running that month where they said, hey, get X amount off your rent or something that they don't have to do all the time, but they were trying to lease it up. So they gave that person a discount off of what they normally would get for market rent. Is that accurate?
Exactly. And sometimes you'll see where the entire tenant base in a property has it. Other times you'll see just a couple of exceptions because it was a friend or they felt bad or they were nervous because of COVID or maybe it was December and traffic was slow, and there's all kinds of reasons.
Okay. Thank you. Go ahead and continue.
So I'm going to pull up another visual, and this is another scatter chart. Like looks somewhat similar to the one that we had on the previous slide. And this is another one where you're looking for a visual to give you a quick reading of what the data is saying. So, like I said, started to mention before that loss to lease sounds like a negative thing. But in an uptrending market like we've had for the last 10 years, as a buyer, loss to lease is a huge opportunity, and again, probably your easiest value add. So what we have here on the screen, this is for a property that we actually purchased back in March of 2021. So again, this is real data, real property. And what we did is on the horizontal axis, which if I remember from high school is the x-axis, we have the date of every lease on the rent roll, right? And then on the vertical axis, again, is the rent, starting at $1,150 going up to $1,400 in this case. So you say, all right, well, Andrew, why would you organize the data like this, right? So the older dates are on the left, the newest dates are on the right. And then again, rent goes up from bottom to top. So what we did is we're taking the actual rent roll from the property that has the lease rates and the date that lease was signed. And what happens when you plot that on this chart so that you can see the date and the amount that the resident is paying, it becomes very clear when you look at this chart, hey, wait a second. Every lease that was signed in the last 6 months, every lease that was signed in the last 6 weeks, they're getting $1,350, but the older leases all average $1,264. So clearly, now you need to dig into it a little bit to find out, well, did they do renovations or not? In this case, and I can tell you this because we bought this property. In this case, they had not done any renovations. They were just finally starting to catch up with the market. And, and I mentioned before, you might see like one lease that's kind of high. That doesn't prove a trend. But when you have 6 weeks consistently of every lease that was signed is significantly higher, that's a sign that you can probably buy that property and take all of those other leases, which are represented by very low dots on this chart, and get them up to that $1,350. So what you're looking for are two numbers. You take the rent roll and you average, again, do this by bedroom, by floor plan. So this is a 1-bedroom. If we take every dot on this chart, the average in-place rent, meaning people are actually paying it, is $1,264. But the last 8 to 10 dots on here were all $1,350. So what that tells us is we can almost do nothing, just buy the property and manage it well, and then get the rent up from $1,264 to $1,350. That's an $86 increase just for managing it and catching it up to market. Now, The reality was, now that we've owned this property for 9 months and the market has continued upward, we are multiples above this level. But this right here will not only gives you a huge insight into the opportunity at the property, but it also gives you kind of a backdoor insight into how the overall market is trending. And we have found this chart to be one of the most powerful tools in our underwriting analysis.
Yeah, this is brilliant. Let's talk about a couple reasons why this is something that should be focused on a lot, but often isn't. The first thing is, like you mentioned, loss to lease is the easiest thing to correct. It's the least expensive and the fastest. You can walk in there and immediately see, well, we should be getting this rent, so we can bump it up to this before we do anything. And you always want to take care of your easiest things first. So if you're buying a unit that has a very small loss to lease, or like it's insignificant, in order to increase the rents, it's going to take a lot more work. You're going to have to do something like add amenities or upgrade your units. You're going to have to spend some money and some time to get there. Looking for something with loss to lease, if you were going to compare this to single family properties, would be like you're getting it significantly under market value. There's a lot of room to get up to the ARV, even before you do a rehab. Another thing is, like when you mentioned this shows you what's going on in the market, what you're referring to is that the higher the loss to lease across an entire market, the faster rents have been rising, and the leases haven't expired fast enough to catch up with it.
Yes.
And that's where you want to be if you're assuming that trend is going to continue, which in most cases it is. Go ahead.
Yeah, and I was going to say, for those listening who are afraid to buy right now, there is a window of opportunity, I'd say, for probably the next 6 to 12 months. There are so many property owners, especially in the, I'd say, under 50 unit space, where because of COVID, fear, whatever, they have not kept up with the rent increases of the last year. And we keep seeing property after property where rents haven't been raised in 2 or 3 years, and they are like 20% below market now. I don't think that's going to last forever. So again, this reveals a huge opportunity.
Yeah, you and I are still finding those deals if you know what to look for. Yep. And this is the big red flag that shines. It says, hey, come look at me. I am worthy. There's something here where people are not taking advantage of me. It kind of reminds me of that old movie, She's All That, where you have that, like the nerd that no one's paying attention to, but really they're the beautiful princess underneath it. This is one of those things that you can see, man, this deal would clean up pretty nice. So, and understandably so. That's why you have it so early in your underwriting process, because if there's not a lot here, there's got to be something else about that deal that makes it really appealing, that makes you think that you could improve it. This is definitely the best to look for. And I can't highlight enough that metrics like this help you understand what's trending in a market in general. So just imagine that if most leases are signed for 12 months, and rent goes up over a 12-month period. Let's say it goes up $100 over the year. Many of those units that signed, 10, 11, 12 months ago are going to be at rents that could be going up. And sometimes the apartment complex just extends them on the same lease that they have, right? They're afraid of vacancy or whatever's going on. So this is how you can identify that there's something juicy here. Anything you want to add before we move on to the next step?
2 things. One, if you're looking for low-hanging fruit, this is like picked in a basket sitting under the tree waiting for you. And then, how do you use this? So you take, in this case, there's $86 loss to lease, right? That's no renovations. So if you're going to renovate the unit and bring it up to a higher level, you take your loss to lease, you add your renovation bump to that gets you your total rent increase that you are putting into your underwriting. And ideally, your underwriting model should have these as 2 separate items: loss to lease and renovation increase. And you want to be able to toggle and adjust those independently. So
that's a very good point. This goes down to the principle of levers in real estate, which I don't know if anyone else talks about, but when you get into investing pretty significantly, you start to recognize, like Andrew, you mentioned the 4 levers that make a property worth more. Cap rates going down might be the biggest lever of all. You can improve your net operating income to make the value of a property goes up, but that pales in comparison to the power of cap rates significantly going down. It's just a bigger lever that moves things more. I say the same thing with the Burr method. If you're looking at ROI, you want to get a higher ROI. Well, you could improve your cash flow. That's one way. But if you can decrease the amount of capital you put in the deal, that lever is way bigger and it makes your ROI skyrocket. So the deeper you get into investing, the more you're learning on where do I get the most bang for my buck? What lever do I want to pull on? the rehab bump versus loss to lease are both levers that make your rent go up, but loss to lease is the bigger lever that's much easier to pull on, and you'd rather find properties that have that kind of opportunity. So there's always going to be both, but this is ideal. You want it to be on the loss to lease side as opposed to having to manage an entire rehab to get the same result.
Yep. It's all risk reward. This loss to lease generally carries the lowest execution risk of any value add strategy.
Love it. Okay. Number 3, what do you have for us?
All right, let's jump on to debt quotes. And I have another example here. And this is real life. This is a debt quote that we received actually on a property that we are under contract to purchase. I did redact some of the specific information for the asset, but when you're looking at debt quotes, what you don't want to do is just get or I shouldn't say you don't want to do, but in generally, what we have found to yield the best results and the highest chance of you being able to perform and close on the deal is to work with a competent and trusted loan broker who will take all of the stuff that you've gathered on this property, package it together really well, and put it out to multiple lenders to help hunt you down the best deal, right? Now, you're not going to do this. You're not going to actually send this to a loan broker every time you kind of get interested in the deal. This is I'd say a deep phase 2 where you're actually going to send it to them. But I want to have an example to actually show people some of the key terms that to watch out for. But when you're doing I'd say an initial phase 2, you want to at least have. If you don't feel like you already have a really good grasp of what current debt terms are, then you want to at least run the deal by a competent loan broker and say, hey, I'm looking at buying this for $5 million. I want to get a loan for 70% of the purchase price. And here's the P&L, and I think I can get rents up this much. Could you just give me a rough idea of what we might expect for loan options, right? That's what you want to do in the beginning because, again, you don't want to waste your time, but you definitely don't want to waste anybody else's time. You want your team members to know that if you send them something, odds are it's going to go through and everyone is going to get paid. So, again, the initial phase 2 is either you already have a sense of what your debt terms can be or you do a quick email or phone call. But if you've done a phase 2 and now, this thing looks good and I'm going to go and we're negotiating an LOI or we really want to strengthen our offer, that's when you might have your loan broker send you what I'm about to go over. So again, this, so once you get into it, kind of what the terms are going to be. So if you look on the visual, and again, if you're, make sure you go to YouTube, the BiggerPockets YouTube channel, so you can actually see this. But you'll see you see 3 different options on here. I'm not sure why it's labeled 1, 2, 4, but it should be 1, 2, 3. So the first is an agency fixed rate, agency floating, and then debt fund floating. So agency, that means Fannie Mae and Freddie Mac, which are your government-sponsored agencies. Debt fund, that's kind of everybody else. That's bridge lenders, life companies, actual debt funds, etc. And we could do an entire episode on just structuring your debt properly. But the main things you'll see here, or the main things you're going to want to take into consideration when you're doing your underwriting is, number 1, the term, right? So if you look on this, you'll see agency is 10-year and the debt fund is 3-year. Especially right now, I won't say don't do bridge because there are appropriate times to do that, but be very careful with loans that have short maturities, right? Long-term multifamily I strongly believe is going to continue to do phenomenal. But what you don't want to do is get a loan that is completely due in 2 years or 3 years and you have no other option other than refinancing or selling, because what if the debt markets, aren't favorable at that time, right? You always want to give yourself a little bit of exit. So
what you're saying is that the shorter that the loan term period is, the less time you have to get things squared away where you're safe, and the less things are able to go wrong before you get hurt.
Exactly. The longer the loan term, the more flexibility you have to adapt to and overcome any adverse scenarios that pop up.
In general, it's a safety feature to have a longer term loan. And I think one of the mistakes that newer people make is they always assume, well, everything's going to go right. And on that timetable, this is where we are. And that is never the case. Nothing ever goes right.
Yeah. You will never, ever exactly hit a pro forma. You will always be a little below or hopefully a lot above, but you will never, ever exactly hit it.
Well, the reason that you come out ahead a lot of times is you give yourself this runway. All of your assumptions are always negative. You're like, well, this is going to go wrong, and this is going to go wrong, and this is good. And if all of it goes wrong, I'm still okay under these circumstances. I think when the market gets hotter, it gets harder to stick to that sort of a disciplined approach that we take when we're buying.
Yeah, I've definitely missed a lot of good deals over the years because of that, but I also sleep well, so to me, it's an acceptable trade-off.
Nice.
So the next big thing you're looking for is loan amount. Different lenders size things in different ways. But you want to know, and so on this particular deal, they were giving us a range of, okay, with agency, you're going to get anywhere between 13.7 and 13.9 million.
Can you define what agency debt is briefly?
Yeah, that's the government sponsored agencies, Freddie Mac and Fannie Mae.
Fannie Mae.
Yep. Which are fantastic commercial lenders. In fact, they kept the market alive in March of 2020 when COVID shut down all the bridge lenders.
I'm glad you say that because we rarely ever say anything positive about the government, but that doesn't mean that nothing positive ever happens. We just tend to not give credit to them.
And it's more fun and easier to complain, right? So than it is to give credit. So. But no, well, that's the thing. So bridge loans are great, but that, especially since you brought it up, that is another risk, right? When this is going to sound negative, but I love bridge lenders. We do use them occasionally, but bridge lenders are like roaches when you flip on the kitchen light at night. They scatter as soon as danger arises, right? So you look back at 2008, you could not get a bridge loan anywhere. March of 2020, bridge lenders, every single one of them left the market. If you were going to get debt, it was going to be Fannie or Freddie. That was basically it, right? So they tend to come and go, and what you want to be careful of, okay, I'm going to get this great bridge loan, or I'm going to refinance into one, and if something happens like March of 2020 or 2008, those bridge loans may not be there. So again, just something to be aware of. That's an additional risk. So I should think of a better analogy because I don't like to call our bridge lenders roaches because they're great partners. But this is the idea of scattering into
they're fair weather friends.
There you go, fair weather friends. There you are. So again, and then if anyone who's on YouTube, you're going to see there's probably about 15 terms on here. So we'll hit the really high ones or most important ones. So the next one is implied rate, and basically what that is saying is what all the lenders do is they take some kind of index, might be the 10-year Treasury, might be SOFR, used to be LIBOR, and they're going to add what's called a spread on top of that. So it might be 2%, or they're going to have a number, and they're going to say, well, okay, the interest rate that we're implying you're going to get is X, right? So if we look at this, it says, okay, fixed agency is between 3.25 and 3.35. If we go floating rate agency, which means the rate can go up and down as the market interest rates go up and down, because that protects them from getting locked into a low interest rate loan, they will give you a lower interest rate to start. So that's between 2.8 and 2.9. And then the debt fund is 3.3 to 3.6. So you can see, depending on which route you go, significantly affects the interest rate. So that's something you're going to want to know what those rates are. The next one is max as is loan to value. This is one of the downsides of agency right now. If you look on here, the agencies are only going to give us 63% of the loan to value. So if you're buying a $10 million deal, they're only going to give you a loan for $6.3 million, whereas the bridge lenders are willing to give 75%, or on a $10 million deal, $7.5 million. In today's highly competitive market, where everyone's fighting to get the returns that are needed, that extra 12% leverage can be huge in whether or not your deal is appealing to investors or not, or whether it hits a certain IRR. But just be aware, higher leverage, generally speaking, means higher risk. So again, which route you go depends on your source of capital, your tolerance for risk, and your business model. But these are all terms that you want to know. I have heard many horror stories of somebody assuming they were going to get 75% or 80%. They get down close to closing, and the lender comes back and says, oh, sorry, it's actually 63. or 62, right? You need to know that up front, because if you're planning on 80 and you get 63, your deal just blew up. So you got to know this stuff in advance and properly underwrite it. Another key one to help prevent that is to know what's called your DSCR. That stands for debt service coverage ratio. So if your property makes $10,000 in net operating income a month and your mortgage payment is $10,000 a month, that means your ratio is 1, right? 10,000 divided by 10,000. You won't get a loan on that from the agency. What they want to see, generally speaking, is a minimum of 1.25. And again, that changes based on market and property size. And that's the number you want to know. You want to ask your loan broker or whoever you're working with, what is that ratio need to be? So if they say it's 1.25 and you're estimating your mortgage payment is going to be $10,000, then that means your property needs to have a net operating income of $12,500. $12,500 divided by 10,000, 1.25, right? That's the number you
Basically,
need to know.
that means a lender's looking to see, can you repay the debt we're about to give you? Can you cover the debt service?
Exactly, and they want to make sure you have a minimum of 25% cushion in case something goes wrong.
Yeah, you want to know something crazy? In the residential space, there's such a demand for lenders that want to be investing in there that our loan company can do a 0.8 debt service coverage ratio. And it's a 30-year fixed rate loan. That's how much money is floating around there in the residential world that needs to find a home, that they're basically saying, hey, if the property brings in $8,000 a month and it's going to cost you $10,000 to get this loan, we'll still give it to you. Now, that doesn't mean that you should ever operate it where that is the case, but they're looking at it saying, hey, they can make up the rest of it with their income. So these standards are definitely, I've noticed, they're tighter in the commercial space, but that's okay because nobody is buying commercial property assuming it's not going to make money. The reason you're buying it is because it makes money. A lot of residential properties purchased for different reasons. You use it to vacation, you use it to live in. You can kind of make it work as an investment, but residential real estate was never intended to be income producing property like commercial property is.
Yeah, right. So, we could probably do, like I said, a whole podcast or a whole Q&A on this, but just keep it moving. I'm just going to kind of hit the next ones really quick. The next one you want to know is how many years of interest only, right? Is it 3? Is it 5? Is it 10?
Yes.
Most bridge loans are interest only for almost usually the full term, so the first 3 years. The next one is what's the amortization schedule look like after it's no longer interest only? So you mentioned residential loans are typically 30 years. Fannie Mae and Freddie Mac are often the same thing, 30 years. A lot of bridge loans don't amortize. It just stays interest only. Some bank loans might be 20, 25 years. So you need to know what the amortization looks like, because it doesn't sound like much, but the difference between a 25-year and a 30-year amortization can have a significant hit on your cash flow because you're paying more principal, right? It builds equity, so that's good, but it's not loose cash flow that you can use. Okay.
So let's clarify that very quickly. If we're talking about an interest only loan, basically you're only paying the interest on the money you borrowed. You're not paying down any of the principal. So the downside is that if it's interest only, you're not building equity by paying the loan down. The upside is you're actually keeping more money in your pocket. Is that a great way to summarize it?
Perfect.
A good enough way?
Got it.
So it can make you, this is why I want to highlight it. It can make you feel wealthier than you are when your cash flow is very high, but your loan isn't being paid down, right? It's usually better for you and less risky because cash flow in the bank can be used to get you out of tough times rather than paying the loan down if you're disciplined with your money. And that's why I want to bring this up is everyone's always excited about interest only loans, but it can create this false sense of security that you have more wealth than you actually do because that balloon payment is still building and you're not creating equity as you're paying down the loan.
Yep. Exactly. So yeah, if you save it, it's an advantage. If you spend it, might not be the case.
And the reason most of these loans are structured with interest only first is they're trying to give you that cushion, right?
Yes.
To build up your reserves, to handle things that could go wrong that you didn't foresee. They're making it easier for you, and they kind of like training wheels for the first little bit. And then after the 3 or 5 years, whatever it is, that's when the amortization schedule kicks in and your payment goes up because you're also paying down the principal.
Yeah, and also especially if you're doing value add, they know that, cash flow might not maximize until 3 years down the road. So another huge one is prepayment penalty. And this has caught a lot of very experienced operators off guard the last 5 years because we all thought rates were going to go up and they never did. They went down. So prepayment prepayment penalty means, if you buy a house, you can pay off your mortgage basically anytime you want, right, David? 6 months, 12 months, doesn't matter. And you just pay it off. You're done. In the commercial world, the lenders say, well, they're taking that loan, they're selling it on the secondary market, and they're promising investors that those investors are going to get a return. So if you want to pay off your loan early, Fannie or Freddie will say, okay, Mr. Greene, you can pay off your loan early, but by the way, we promised our investors a certain yield, so you have to pay us all that extra interest we are no longer going to receive so that we can keep our investors happy. And that's an oversimplification. It doesn't quite work that way. It gets into like calculus. If it really is nasty stuff, all these symbols that I haven't seen since my advanced engineering classes. But basically, the idea of it is, if you pay off that loan early, you're going to have a large fee or payment or prepayment penalty that you are going to have to pay. So if you're going to sell a property in 3 years, don't get 10-year fixed debt, because you're going to have a huge prepayment penalty. They also call it yield maintenance.
There's always fancy words to describe very simple things when you're dealing with multifamily. You and I should make like an article, right? Like yield maintenance, Dutch interest, even agency debt sounds much cooler than Fannie Mae loan. Loss to lease is a cool thing to say. There's a lot of it. Like when you get into this space, there's definitely words that get thrown around and you're like, what does that mean? And you're like even cap rate, like, oh, that's just the return you'd get if you didn't take debt.
Yeah, if you bought it for cash. So, and the other two things are what kind of lender fees are you going to have? Is the broker going to charge you a point? Is the lender going to charge you a point? Is there an exit fee? Most bridge loans, while they don't have prepayment penalty, they will have an exit fee, meaning like when you repay it off or refinance, we're going to charge you a point on the back end, right? Or a half a point or something like that. Again, nothing wrong with it. You just need to be aware of it and make sure that you underwrite for it. So, all right, next one is insurance quote. And don't have a visual on this just because it gets pretty dense, but I'm just going to touch on a couple of things. Number one, never, ever, ever use the seller's number for insurance, right? I can't tell you how many times we find sellers that are either underinsured or improperly insured, or their brother, sister's cousin is giving them a discount that you're not going to get. There's all kinds of reasons not to use the seller's number. Another reason is a lot of times you'll come across a situation where someone is insuring based on ACV, which stands for actual cash value. You want to always insure for replacement value, right? I made this mistake in my first deal. Fortunately, it worked out okay because we didn't have any claims. But if you have replacement value, it's going to cost you more up front, because what the insurance company is going to do is they're going to say, okay, if your building burns down, it's going to cost $100 a square foot for us to rebuild it, right? And if your building does burn down, basically that's how much they'll pay you. Again, we're simplifying. If you do actual cash value, saying, well, geez, I can cut my premiums in half if I go for actual cash value, then what the insurance company is going to do when your building burns down is they're going to come in and say, well, yeah, you know what, this was built in the 80s and the roof was 10 years old and this was 5 years old, so they're going to apply depreciation to it, and they're going to say, well, the actual cash value of this is 50%. So here, your $5 million building, here's $2.5 million, good luck, right? So you got to come up with the extra 2.5. So do not fall for the temptation of actual cash value insurance policies. And in most cases, a lender will not let you do that. But if you're buying a property for cash, or you're doing some kind of non-traditional debt structure, don't fall for the trap of, cool, I can save a little bit on my premiums, because the minute you have a loss, that will come back to bite you big time.
Well, by calling it cash value, that's misleading.
It is.
Oh, we're going to get the cash. Right?
Well, and that's why
all that means is we're going to go ahead.
Yeah, that's why I did it the first time. Like, wait, my premiums are like half, and it's cash value. I'm like, okay, cool. And then a little bit down the road, I figured out what that actually meant. again, this was 10 years ago. We know this stuff now. I said, oh, you know what? Let's go ahead and make this replacement value. Thank you. And I got my 1 year premium savings and considered myself lucky and moved on. Never did that again.
It's one of those things that in multifamily, there's big words that can be used that can be misleading. I've said this before. I have like a general rule that if anybody says finance instead of finance, I have to look very closely at everything they say because I assume they're going to try to pull the wool over my eyes. So don't be that person at the cocktail party that tries to sound smart by saying finance. We all know what it's actually referring to.
So I'll try to, so we'll speed through a handful of these other things because they're a little more self-explanatory. The two main things you are going to need to get an insurance quote are the total rentable square footage and the annual revenue, right? If there's those are the two main things you're going to get. And you send that to your insurance broker, and he should be able to give you a good rough ballpark idea of what that's going to be. Some other things you're going to want to know. The next biggest thing is there a history of claims, right? If they've got 3 other insurance claims, it's called it's called a loss run, which is the history of losses. Your rates are going to be higher because the insurers, understandably, are going to be nervous about that building. You also want to find out, have there been any shootings or assaults, right? So if you go on Google Maps, grab the little yellow man, drop him on the property, and he runs away, you should run away too. Because what that means is if there's been shootings or assaults or any kind of violent crime, you're going to have an extremely difficult time getting insurance in the first place. If you do, you're going to pay more for it, and they're probably going to exclude incidents of violence, which means if someone gets shot in your property, it's not covered by your insurance company, and they go to sue you for $10 million because the shooting was, of course, your fault as the landlord. The insurance company is going to say, "Well, good luck, David. That one's on you. We excluded that." So you want to know, that's part of your screening too, right? Hopefully you've already screened for this and you're not looking at a property with shootings, but you're going to really, at this point, you want to make absolutely certain. Now, some other questions. Does the property have aluminum wiring if it was built especially 60s or 70s? Is it sprinklered? That doesn't mean it has nice irrigation for the landscaping. That means, does it have those little sprinkler heads inside the units? And is it in a flood zone or not? Flood zone is a completely separate policy. And again, if you go back to our screening, we don't buy in flood zones for a host of reasons. Doesn't mean you can't. That's a business decision for us, but we don't. And here's a tip, David. What do you think is one thing that flood insurance does not cover flooding from in the commercial world?
Maybe your own fire sprinklers when they go on.
Actually, we've had that happen. That's covered. Rain. Flood insurance doesn't cover flooding from rain. And you say, well, okay, where else would flooding come from?
Dam breaking.
Yeah.
Nearby.
So, and here's the thing. So we learned this a few years ago, fortunately not the hard way, just by asking enough questions. So when you're getting what flood insurance covers, it covers flooding from a body of water. The lake overflows, the river overflows, the ocean comes in on storm surge with a hurricane. If it just rains 12 inches and the water piles up in your parking lot because it can't get away fast enough and floods units, that often does not count and often will not be covered. In most cases, you have to specifically get that written into the policy that is covered, and that saved our butts this year. We had a property in Florida we bought. We specifically made sure that was written in there. 1 month after we closed on it, tropical storm came through, 17 inches of water in the parking lot because of rain, not tied to a body of water. If we hadn't had that clause inserted into the insurance, again, not in the flood zone. It's not in the flood zone. It's just rained too much. Then we would have been out of luck, some big bucks. So that's a really big one. All right, so moving on to property taxes.
Number 5.
Yes, number 5. Taxes. This one's actually absolutely critical. This is another one where sellers and occasionally some brokers will try to get this past newbies and say, taxes are really low, especially in markets that we're seeing now where prices have been trending up significantly. The property taxes are lagging, right? And this is something that is very unique to each county and state. So, we're going to go over some general processes for estimating property taxes, but you've got to dig in and find out how your local municipality handles this. Everyone is different. So I'm going to go ahead and pull up an actual tax statement to show this. But basically, the gist of it is you want to go to your county assessor's website, download the current statement, right? And then use that to determine how and when they're calculating reassessments, and then estimate your taxes, future taxes, based on your purchase price and how they're doing that. So I'm going to go ahead and pull up. This is an actual property tax bill. This is from the Valdosta area, or actually Lowndes County in Georgia. And what you're going to see here in this area, they do a fair market value. So they estimate a value for the land and a value of the buildings. They add that together, and then they use that value to determine the taxes. Now, it's not that simple, though. For some reason, nobody's been able to explain this to me. And if a listener hears this and knows the answer, I'd love to reach out and let me know. They don't just work from that fair market value. They take that fair market value, they multiply it by 40%, then they take what's called a millage rate. And a millage rate is, again, just another one of those fancy terms for a number that they're multiplying by to come up with whatever number they want, right? So that's how there's two levers that the municipalities pull to change your taxes. One is the value, two is the millage rate. So what they'll do in this county is they take your fair market value, they multiply it by 40% because I guess it's fun. Then they multiply that new value by the millage rate, and that gives you your taxes. So in this example, again, go to YouTube. I've highlighted these numbers in yellow, so it's a little bit easier to see. The fair market value for this parcel was $2,476,000. Multiply that by 40%. The taxable value is $990,000. The millage, they have it broken out. There's actually multiple millage rates. One for the school, one for Parks and Recreation. Great show, by the way. One for the Industrial Authority. Whatever. And so the total millage rate is 34.77. Again, it would makes sense. You would think, well, just multiply by 34.77. No, millage rate I think stands for mills, which means you divide by 1,000 first. So you take your taxable value, multiply it by 0.034. That gets you your net tax on the bottom right, highlighted in yellow, of $34,439. You say, okay, that's great, Andrew. That just tells me what today's taxes are, right? So how do you use that? Now, this tells you how they are currently calculating taxes. So you take that formula, fair market value times 40% times the millage rate equals taxes. You go in and you put your purchase price in there, right? So now take your new purchase price times 40% to get your new taxable value times the millage rate equals your future taxes. Now, what that does is that's actually telling you your absolute worst case scenario. That's telling you if the county comes in and says you bought it for this, we're assessing you for that same price. In most cases, that doesn't actually happen. What we do is we take our purchase price, cut it to 80%, and then put that number into this equation, right? And again, there's a lot of other factors. Some areas do this every 5 years. Some areas do it as soon as you buy it. It's different by state, by county. But the gist of it is go pull a tax statement, number one, understand how they're calculating it, and then use their method of calculating with your new purchase price to figure out what your future taxes are going to be. And in many cases, yes, your taxes may double or triple when you get reassessed. And if you don't factor that in, your deal just blew up 2 years down the road.
Very good. And if this isn't making sense because you're listening on the podcast, check it out on YouTube. There's a visual aid. You can see exactly what Andrew's walking through. It actually makes a lot more sense when you can look and see. It looks like the millage rate is basically how the county is splitting up the property tax amongst the different like municipalities or organizations that need the money.
Yeah, and generally speaking, you don't need to worry about how they're splitting it up. You're just looking for the total. Mm-hmm. I did highlight Parks and Rec on there just as an example. But really all you care about is the total. So, again, so you use that total number in your calculations, and, if you're interested in where it's going, that's fine, but it doesn't affect your underwriting.
Okay, that wraps up property taxes. Moving on to number 6.
Yeah, number 6 is property manager's opinion, and this is exactly what it sounds like. If you should already at this point on your team have a well-qualified property management company that is, again, part of your team that you can get their opinion. And you're not calling them on every deal that you look at, but this is phase 2. You're getting serious, right? So what we do is anytime we're at this point with a property, we will email our property management company and say, hey, are you familiar with this property? And are you familiar with this submarket? And could you please give us your opinion, right? And typically what they'll do is, and once in a while, in the beginning, before we knew our markets and before we were screening, they'd say, "No, run away, stay out of there. We don't want to manage that. You don't want to own it." But now with the screening, that doesn't happen anymore. So many cases, they know the property. A good property management company is going to know the property, and they're going to be able to give you feedback. And ideally, they'll send someone over there to drive it for you and be like, "Oh yeah, we drove over there and." It's a great property in a great location, but there's trash everywhere, which, that's an opportunity. That's really easy to fix. Doesn't look like anyone cares. They have no marketing, but it's on this great high traffic corner, and, you could put a playground and a dog park. And if you if you added some landscaping, based on, and by the way, we manage a property a quarter mile down the street that's getting $400 more a month. This one, not quite as nice, so you could probably get $200. That's the kind of feedback you're looking for. Someone who's already an expert in that market to give you feedback on the market and on that asset and give you their opinion of it. What you don't do is you don't send them a budget and say, "Can we make this happen?" Because you don't want to taint their feedback. You want them to come back to you with a blank slate. And again, if you're screening right, most of the time that should be at least somewhat positive. Every once in a while you might miss something, but that's exactly what it is. You want a property manager's opinion of the asset. And then once they do that, you might go back to them and say, "Well, geez, I'm planning on, my loss to lease says I can get $125 rent increases. Do you guys think we can do that?" And they will either confirm it or say, "Nah, it might be 80, or not, geez, you can get 150, no problem," right? So that's exactly what it is. You want to get a qualified property manager's opinion of the asset, the location, the submarket, and do they want to manage that for you?
Yeah, and be careful that you don't do what you mentioned when you start to fudge things on a spreadsheet to make it work. Sometimes you feed them the information you want them to get back, and they, of course, want the revenue that's going to come from managing it, so they regurgitate that back to you, and now you've tricked yourself into thinking that they are capable of
Exactly. Don't feed them anything. Just blank slate, ask them their opinion.
Their own way. Very good. Okay, number 7.
Yeah, renovation budget. So, if you remember from the phase 1 underwriting, we basically just did kind of a quick guess, like, I think we can spend $8,000 a unit renovating this, and we'll do $200,000 on the outside, or whatever the number is, right? And because the broker said you can spend this much and it'll be great, so you do that on the first shot. Phase 2, ideally somebody on your team, either you or the property manager, has toured this property. And you've walked through and you've identified things like, and again, this is an example from an actual property that we purchased. And this is, we've walked through and we said, okay, well, we're going to spend, and we don't have time to go into the details of, how we came up with this, but we're going to spend $600,000 on renovating interiors. And let's see, we need to do about $25,000 in landscaping upgrades. Parking lot needs to be resealed and restriped. We're estimating that at $63,000. New signage, $31,000. Fencing, $35,000. So basically, if you go on YouTube and you look at this, what we've done in phase 2 is, rather than just a guess of a few $100,000 inside and a few $100,000 outside, now it's really coming down to it. And we're just underwriting. We're not under contract. So we're not having contractors go out and give us bids. We are leaning either on a combination of our own knowledge, or if you don't have that knowledge yet, go to the property managers and say, "Hey, I've looked at pictures, I've toured this. I think these are the 8 projects that we need to do. What would be your range of how much this would cost? How much should I plan for redoing the parking lot? How much should I plan for putting in a nice, pretty monument sign, right? All of those things." So, again, phase 1, you're just throwing in some high-level numbers. Phase 2, you're breaking it down by project, right? So, again, these aren't hard bids. They're just getting a lot more granular so that you aren't going to, because you don't want to underestimate and run short, but you also don't want to overestimate and lose a deal that otherwise could have worked, right? And two other things I'd really want to highlight on here You look at the bottom, you'll see contingency, 126,000, and long-term capex reserve. Two very important things that I often see people leave off. If things go great, you'll get away with it. If they don't, you're going to be in trouble. Contingency is exactly what it sounds. That is, oh, geez, you know what? Cost of appliances just went up 10%. It's going to cost me more, right? Or, oh man, we just found a bunch of windows that are cracked and fogged. We got to replace them. Well, that's not cheap. It's just adding in some room for finding stuff that goes wrong. Or you might discover, well, geez, if we do this additional thing, we can bump rents even further. You want to have brought the money in up front to be able to do that and maximize the value of your investment. The second is long-term capex reserve. For us, it's just the number we're comfortable with. It might be different for you. We just do $1,000 a unit, right? Because we know we're typically going to hold for 5 years. Things happen. Maybe the roof gets damaged and you have a $200,000 deductible on your insurance policy. Well, guess what? That's either coming out of your pocket, from your investors, which you never ever want to have to ask for, or your long-term reserve that you started this out with in the first place. So that's what that long-term capex reserve is. Something happens year 3 or 4 or 5, or if you're holding long-term, maybe even year 10, so that when that comes up, you're like, no problem, I got this. Your investment's safe, your investors are good. That's an absolute key line item. But yeah, lots more we could jump into, but I know we've been talking for a bit, so that's kind of the gist of what you're doing phase 2 renovating or renovation budget.
And there's almost always going to be a renovation budget of some sort because you're usually looking to buy something that has meat on the bone. And if there's meat on the bone, then there's work you're going to have to do to get there. So this is something that, like, I know a lot of people have questions about. How do I know what the rehab's going to cost? It's kind of something you got to look at a lot, speak with different contractors, get a feel for a baseline of what that's going to look like. But you definitely want to be comfortable with it because anytime you're buying an asset of this size, there's going to be some kind of renovation that needs to happen.
Yeah, absolutely. And like I said, there's two types. There's, I would say, required renovation, like deferred maintenance, and then there's opportunistic, right? Like, hey, if we do this, we can attract better quality residents and bump the rents.
Right.
And then those are two categories.
Okay.
Yeah. So, all right, the final one.
Number 8.
Yes, number 8 for today. Final one for today is follow up on P&L items on the T12, which stands for trailing 12. That's a profit and loss statement that is broken, that shows you an entire year snapshot by month, right? So it'll show the income and the expenses for each month, 12 months, lined up in columns right next to each other. Property P&Ls are like, fingerprints, snowflakes, and penguin mating calls, right? No two are the same. Like you'll see stuff from handwritten on pieces of paper to beautiful, yardy printouts with every single account perfectly lined up and everything in between. And you will see stuff on P&Ls that's sketchier than a photo of Ozzy Osbourne at church, right? And this is where phase 2, you ask questions about that kind of stuff. So, in general, and I think we didn't want to do this on YouTube because those 12-month P&Ls are so dense, but we will provide one in the show notes for everyone to go look at after the fact. But some examples of things you're looking for is anything that's unusually high or unusually low, right? If you expect insurance to be $300 a unit and it's $450 a unit, that's a red flag. You want to find out why. Maybe they just have a bad insurance broker, or maybe they've had 3 fires and a shooting, right? And again, some of this stuff gets redundant, but that's on purpose, right? You want redundancy so that if something important gets missed on one step, you'll catch it on another. And it all ties together. So missing payments. I can't tell you how many times we see the landscaping bill suddenly doesn't get paid for 2 months. Well, where did that go? What happened? Why? Or the utilities go way up and go way down. Does that mean they're having underground water leaks all the time? Does the residents leave water on? I mean, what's going on there? Oftentimes you'll see strange accounts. Large credits are another big one, right? You'll look at, oh wow, the repairs and maintenance on this property looks is really good. It must be a great property. But then you look closely at the P&L and wait a second, there's a $30,000 credit. Like, where did that come from? Because if you just look at the end number, it's gonna be wrong because somehow they reduced that expense by $30,000, and there's lots of legitimate reasons for that. But this is where you go ask, right? You're looking for opportunities and traps. So again, if their insurance is $450 a unit because they maybe have not a great loan broker and you can get it for $350 legitimately, that's an opportunity. If it's $450 because they had 3 shootings, that could be a trap, especially if you assumed you could get $350 on in phase 1. These are the things you're asking questions for. Other things that you might run across are things like HOA fees. We've actually owned an apartment complex that had HOA fees. It's not a problem as long as you underwrote for it in the first place, right? That's usually you're not going to assume that. You're not going to automatically underwrite for it because most don't have it. But if you're on the hook for $20,000 a year for HOA fees, you don't put that in your underwriting, all of a sudden you're behind the 8 ball when it comes to hitting your pro forma. We actually saw a T12 one time that was a T13. Meaning they had 13 months of data in 12 months, which means all the income and expense numbers were inflated. Artificially inflated. I don't know if it was intentional or not, but it was not accurate. Stuff like cell phone tower income.
I should probably say, when we say T12, we're talking about the trailing 12 months of profit.
Yeah, and so they had put 13 months on there for some reason. You'll see stuff like cell phone tower income, billboard income, people leasing out units corporately, things like that. All good stuff, but does that transfer to you? Does that stay with you? Does that terminate? When does that lease expire? Again, things to look into because, we have a property with a billboard. It's great income, but we had to make sure that when we bought the property that transferred to us, right? We found one, we had a contra account on it. And I'm like, what the heck is a contra account? Basically, my understanding of the accounting definition or the in English definition, a contra account is an account that you use to adjust another account up or down to make it look like how you want to make it look, right? So needless to say, that was something that we dug deeply into. Like, okay, why are you guys just why do you have a contra account? And why are you trying to use it to adjust these other accounts, right? It was definitely a red flag. And actually, we never got a clear explanation, and we didn't end up buying that property. So, again, those are just some examples of that things that we've come across, and you could probably list 100. I'm sure everyone's listening is like, oh my gosh, you should have seen this thing on here that I found one time. But that's what you're doing. Anything weird or different on that P&L, and phase 2, you want to ask questions of either the broker or the seller to clarify what that is and find out, is it an opportunity or is it a trap?
Beautiful. Okay. That was really good. Like I promised everybody, you're getting a masterclass in evaluating multifamily property. Can you give us a brief rundown, Andrew, of the 8 steps in underwriting phase 2?
Yeah. So underwriting phase 2, the quick recap. Number 1, rent increases. There's 2 components of that. Market rent growth we talked about last time, and then this time we talked about renovation increases, bringing it up to market. Number 2 was loss to lease. Meaning, hey, you know what? The last 5 leases were signed for $100 more. If I buy this, my research indicates that I should be able to at least get the remaining leases up to $100. And then by eliminating that loss to lease, I effectively bring my rents up $100. So that can be a huge opportunity. Third one is debt quote. When you're doing phase 2, you're getting serious about hopefully making an offer. And you don't want to just be guessing at your debt anymore, because that's one of the big levers. You want to at least get a quick verbal, or if you're getting deeper into it, get an actual kind of like quote matrix like we showed, where they're saying, yeah, if you go this route, it's this, and if you go this route, it's this. Number 4 was insurance, where again, you're not having everyone go through the full process of getting an entire quote, but you're going to give them the total square footage and the annual revenue at a minimum, and say, hey, ballpark, what's the cost? Is it $300 a unit? Is it $400 a unit? Number 5 is property taxes. You want to find out, how does that municipality currently determine property taxes, and using that method, after you buy the property, what does that mean for how much your reassessed taxes are going to be? That has a huge, huge impact on your P&L.
That's for all real estate. Don't look at what a property taxes currently are. Unless the values are going down, I suppose. When I bought my first property, now that I think about it, it had sold for $565. I bought it 2 years later for $195. I paid property taxes. My impound account up front on the higher value, and I got a refund check. But we haven't seen that in a long time. It's usually the other way, where you're going to get another check at after closing that says, hey, you owe us more money. So it doesn't matter what the person is paying right now. It matters what the value is going to be based on, which is usually your purchase price when you buy it.
Exactly. Number 6 was the property manager's opinion. Get someone who just knows that market inside and out. Get their thoughts on it and don't feed them. Right? You're hoping for good feedback, and so it's tempting to give them something to hand back to you. Don't do that. Just ask them blank slate. Number 7 is renovation budget. You're not having contractors go out there. You're just trying to break it down and get a little more granular and say, okay, well, here's the list of projects, and here's how much I think those are going to be, and that totals up to this. Because as best as possible, you don't want to overestimate, but you also definitely don't want to underestimate. And the final one is just following up on P&L items that either don't make sense, or that could be an opportunity, or could be a trap. And those are the 8 things that we covered, and there's lots of other little sub pieces and different parts that you could dive into. But those are kind of 8 key ones that are part of phase 2, and determining is this cream or is this a turd? And if it's hopefully cream, then that's where you decide, okay, am I going to put an offer on this? And then get into, well, how do I write that offer? How do I decide the terms? What's going to be appealing? And go from there.
Well, thank you. I actually get to brag a little bit. You made me very proud, everyone. This is why this is my multifamily partner right here, because he's this good. So thank you for sharing how you put this system together. I'm happy I got to play a small role in encouraging you to leverage some of this stuff out to these other people, because that's grown into this incredibly detailed, very, very accurate way of analyzing properties that is leading to success. So do you mind sharing a little bit about what you're up to right now? What properties are you looking at? Like, what does your week look like, and what success are you having?
Yeah, we're actually, like I said, with this, going back to the loss to lease that's been created by the last year and a half, 2 years, there's a lot of opportunity out there. We're under contract on a couple hundred units right now, and then we actually just got a offer accepted. We're not fully under contract, so I don't want to give out any specifics. But we got an offer accepted in a market where it's one of the strongest, fastest growing markets in the country. We already own multiple properties in that market, so we know it well. So we're super excited about that one, and that is actually going to be our first ever 506C. I think we've done 16 or 17 506Bs where we never talk about it. Basically, you have to already know us just to find out about it. But this one is going to be 506C, and we're going to do that. We're doing that one with you, David. So if that property, if we do get it fully under contract, is something that you might be interested in, it's investwithdavidgreene.com, right, David?
Yeah, if they go to investwithdavidgreene.com, you can fill out a form that will basically end up putting us in touch with you, where we can share more details about this deal if this is something you want to invest with Andrew and I on. Can you break down what 506C means?
Oh, yeah, sorry about that. So that gets down to the SEC regulations. So 506B means if you're raising money for a deal, you can't solicit. And solicit basically means anything, right? You can't talk about it on a podcast. You can't post about on Facebook and LinkedIn. You have to have a pre-existing relationship with anyone that's investing. 506C means you are allowed to talk about it, but anybody that says, hey, I want to invest, has to be accredited and verify that they're accredited. So that's the difference. It's just a different set of regulations and rules that the SEC puts out for syndicating.
Now, if you don't know what that means, that's okay. You can still go to that website. You can register. We will let you know if this deal would work for you in the status you're in, or if a different situation with me would make more sense. But Andrew's being a little bit humble here. He found this deal off market. It's a great area. The property that we bought just before this one has exceeded everyone's expectations times 10. This is the best part about Andrew is he's always super conservative as underwriting. He's like Eeyore when he underwrites, but he's like Tigger when he performs. It's perfect, right? So he always under promises and over delivers, and that's why I partner with him. So if you would like to partner with us, please go there. Now, the last stage in the entire underwriting system, we've gone through phase 1, which is, would this work? Phase 2, is this cream or is this a turd? Phase 3 would actually be when you send the letter of intent and you actually go through the process of putting it in contract. Can you share, Andrew, if they want to learn more about what to do at the last phase, where can they go?
Yeah, go to davidgreenwebinar.com, and I think what we're going to do is David and I are going to do a webinar on how you put together an LOI. So, I said you've been through all these steps. It's a lot of work. Fortunately, you found one that looks really good. You want to own it, and we'll talk about what kind of terms do you put in the LOI? How do you determine what can you say? Do you put in references? Do you not put in references? What if your offer seems kind of low? Do you still do it? Do you not do it? How do you communicate that with the broker? How do you communicate with the seller? We'll go through and talk about crafting the best offer that gives you the highest chance of getting the deal, but at a minimum gives you credibility and builds your reputation in the market.
Now, we know not everyone listening to this podcast is going to go buy a $50 million apartment complex. You might not even buy a $5 million one, but you do now have the information that you would need if you wanted to do it. So our goal here was to basically show you every step, phase 1, phase 2, and then a webinar where we can talk with you with more length, basically, and we can answer more questions and we can actually get out in a podcast about what to do when you want to write an LOI and how you put a property in contract. I can personally vouch for Andrew. He's a great dude. He's super smart. He's very good at investing. We've made a lot of money investing together. And I feel comfortable telling other people this is the person that I invest with because that means a lot to me. So I would highly encourage you to go there and register. There's other webinars too. I do other stuff on lending practices or short-term rentals. There's a lot of stuff where I try to get back to the BiggerPockets audience. So I highly recommend everybody listening to this to do that, as well as if you would like to invest with us. That's a great place to start. Any last words you want to leave people with, Andrew?
Yeah, I would just say, I know that was, I guess, again, hopefully everyone's still awake. I know that was a bit dense, but that's the reality of what underwriting even a 5 or a 500 unit property is. In order to do it right, you have to get down and dirty into the weeds of these numbers and these P&Ls. And if you're saying, oh my gosh, Andrew, I could do this for 30 minutes and I'd run away screaming. Go partner with somebody that loves it or hire somebody that loves it. But in order to properly underwrite, this is the type of thing that you need to do. And yes, there's other ways of doing it. There's other ways of looking at the data. This is just what we have found to work exceptionally well for us. But as long as you use the principles that we talked about, then you should be able to hunt down some really good deals for yourself.
That is wonderful. You reminded me of something. When I was first in the field training officer program as a police officer, I worked for an agency that covered 5 counties. So when we were training, they would drive us through every county and go to the main areas that they thought we would need to know in an emergency. This is the hospitals in these areas. These are the local police departments that if you ever need like backup or you're trying to figure out like what can I do in emergency, here's places that you can go. Here's places where the county stores equipment that we might need in the case of a flood or something like that. And they knew that we would never remember all of these places it's impossible to remember that much information. But the thing is, they also understood when I was trying to find that place 3 years down the road, I would remember little landmarks that I saw, or I would spot the building and say, that's the one that I'm looking for. It sits in the back of your head. Now, I couldn't walk you through, turn right here, turn left here. But when I got close, I recognized I'm on the right path. That's what a podcast like this is. You are never going to remember all 8 steps, plus the 4 levers we talked about before, plus the 6 steps in phase 1 underwriting. You don't need to. No one is going to learn it like that. It's getting the concepts in your head. And as you take this journey, those will stick out like milestones. Just like when you're in the woods on a hike and you're not sure exactly where you are, but you remember a certain mountain peak, or you remember a tree that's in a certain place and it's that, oh yeah, I'm going the right way. That's what information like this functions. So don't beat yourself up. If you're listening to this and and you're thinking, I'm an idiot. I don't get it. I'm never going to understand this. Andrew didn't understand this when he was first putting this together. I don't understand this stuff. Like, it's something you have to do over and over and over, like everything else in life. So don't beat yourself up. Just instead think, if you thought that was interesting, that was fascinating, that's a good thing. That's your fire. Add wood to that fire. Build that fire, pour into that fire, invest into that fire, build up that desire to learn more. And as you stick with it and you stay in this world long enough, this stuff will start to make sense and you'll start to get confident.
Yeah, that was an excellent recap. This doesn't come on the first time. This was built and honed out of looking through literally thousands of deals and properties. Mm-hmm. It's not something that I or anyone else starts off with.
Well, I'm really glad that you shared that thousands of properties expertise and experience with us here today. And I hope people join us on our webinar where we can talk about it more and consider investing with us and getting some experience and making some money in the process. Anything you want to say before we get out of here?
No, it was, like I said in the beginning, I put the earbud in the right ear first, and so far that's working. It's been a good day, and it's good talking with you, and hopefully we do it again here soon. So,
how can people get in touch with you?
Easiest way is LinkedIn. I am that's probably the only social media platform where I am somewhat active. And then our website, VantagePointAcquisitions.com, is a couple of different tabs on there. If you want to connect, fill out the little form, and that comes to my inbox.
All right. You can follow him there. You can follow me at David Greene 24 on social media. I also have a brand new spanking website up, davidgreene24.com. And I will be, or maybe by the time this releases, I already have released a free text letter that kind of explains what I'm doing, what I'm up to, what kind of properties I'm buying, where I'll be speaking, and how we here at BiggerPockets can help you to grow in your own education to achieve your goals. So please consider following me there. And if you like this episode, go back and make sure you listen to episode 571, where we break down phase 1 of this process. And then do you remember your other episodes you're on, Andrew? Was it 170?
Yeah, it was 170 and 279.
So this is your 4th time on the podcast. That's how good you are.
Wow, that puts. I guess that's a pretty small group. I feel honored.
Yeah, you're on the Mount Rushmore. But
well, thanks.
I have a really funny meme that says the Canadian side of Mount Rushmore, and it has like a bunch of the butts of the presidents as they're like sticking their head.
Oh, that's awesome! I love
from the reverse side. I always thought that was funny. All right, I'm gonna let you get out of here. This is David Greene for the BiggerPockets Podcast, signing off.